In a world of twisted facts, alternative narratives, corrupted corporations, and hacked feeds, how can we decipher the difference between truth and fiction? It's time to take back the truth. Read Robert Kiyosaki's Fake and learn the signs to recognize fake money, fake teachers, and fake assets. Determine what's real in a world where falsehoods are a weapon. Don't let fake advice destroy your financial future. Visit therealkiyosaki.com to read Fake by Robert Kiyosaki. That's therealkiyosaki.com.
This is the Rich Dad Radio Show. The good news and bad news about money. Here's Robert Kiyosaki.
Hello. It's Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And we have a fantastic program for you. And today's program is about, look, face up. I warned you. If you listen to the Rich Dad Radio program, you were warned. And what I mean by that is, for the last year or so, we've been saying, hey, watch out, this market's going to go down. But did people listen? No. So the question is, what's happening next? Is the market going to come back up? Is the economy going to get better? Or are we going to crash? Could we be heading for a Great Depression? I was at Christmas dinner this year, just a few weeks ago, and there was a couple of guys my age, they're baby boomers, and they're crying in their tea. They're just crying, drinking their beer, and one guy was really angry at me because apparently I said on some TV program that I was excited about the crash coming. Crashes are good. And he got so angry at me. He says, how can you say that? It's not funny. I'm losing everything, da-da-da-da-da. And the market dropped. The next day went up. He was happy again, and all this stuff. But the thing is, he was warned. If you listen to the Rich Dad radio program and it cost nothing, you would have been warned. Look, the question is, what's going to happen next? You already know the markets are up and down. The economy looks good. Everybody says, unemployment's down. Everybody's happy and all this. But is that really true? So that's why we have the Rich Dad radio program. I don't sell you anything. I'm not selling you a stock, bond, mutual fund, ETF, or real estate. All we do is we educate people. We make no recommendations. We don't say buy this or sell that. So you've been warned. And one of the persons that warns me is one of the best in the business. Today's guest is Bert Dohmen, fellow Hawaiian. In fact, he's in Hawaii today. We don't live that far apart in Hawaii. And he has the most important subscription that you can subscribe to. You want to invest in your financial education? Invest in Bert Dohmen's, Dohmens, Wellington Letter. Because since around July this year, he's been warning us. This baby is going to start rocking and rolling. In fact, he started warning us last December that 2018 was going to be a rough year. And the market boomed, with a Trump tax cut, and everybody was happy again. So this baby is going to keep going, the Fed and the rates and all this other stuff. But Bert has been, saying what was going to happen, and it happened. It happened. You were warned. So please listen to this interview with my dear friend and one of my personal teachers, because I call him when I have questions about what's really going on. So Bert Dohmen's Wellington Letter I recommend for everybody simply because it's not one of these things, well, buy this and sell that in the stock market. Bert actually his Wellington Letter is one of the most informative, historical-based fact document that if you really want to get an education of what's going on, not just buy this and sell that, it's the Wellington Letter. So our guest today is Bert Dohmen, and he's going to be talking about what just happened, but more importantly, how can you be prepared for what's going to happen? So, Mr. Dohmen, welcome to the Rich Dad Radio Show. I have a lot of questions for you because a lot of stuff's going on, right?
Robert, thank you very much for the wonderful introduction. I hope to live up to some of your glowing remarks.
Well, you do, because look, hey, Bert, your predictions were so unpopular, but they're coming true. That's the whole thing. I got a stack of Wellington Letters right here. And like you were talking about the future, but you were talking about what really did happen. That's amazing.
Yeah. Because the problem is, if you watch financial TV,
oh, God,
you will only see analysts talking about earnings and a good economy. And I wrote this summer from then on, and every issue I wrote, forget earnings, forget the economy. This market is going to go down because of the credit market. The credit markets were starting to freeze up. And nobody wanted to believe that was important because nobody seems to really understand credit markets. This is very important. When suddenly in November, there were zero junk bond offerings, new offerings, not because nobody wanted to raise money selling junk bonds, but because there were no buyers for junk bonds anymore. The leveraged loan market, which is what the banks, they sell their loans that they make, they put them in a pool and sell it to mutual funds and so on and institutional investors. They couldn't find any buyers. A number of them, hundreds of millions of dollars of intended offerings were pulled because there were no buyers. This is the kind of thing you have to watch. When the credit markets freeze up, the ball game is over. This happened in 2007. The commercial paper market froze up. And this is short-term, 90-day IOUs, basically, that large companies sell, usually billions of dollars, and they roll them over every 90 days, And suddenly they couldn't roll them over anymore. There were no buyers for the new offerings. And I said, that's it. We're going into a big meltdown in 2008.
Is that because they don't have any buyers because the buyers are out of money or they're pulling back?
They're pulling back.
They're pulling back. Let's
risk avoidance.
So again, everybody, this is the thing I love about Bert's Wellington Letter. He is an educator. He's a teacher. So most people look at the stock market. What is the credit market?
Yeah, the credit market is basically the willingness. It shows the willingness of lenders to add to their risk portfolios. And when the lenders, like banks and so on, and you've got business development companies, et cetera, when they said, hey, it's getting too risky, our default rates are going up, let's reduce the number of new loans, or let's stop making new loans. And that's the end. That's the end of the cycle. So what people think, listening to financial TV this morning, they think that this whole thing of the last 3 months, this whole the tremendous decline in the stock market was just like a summer storm, and this is the time to pick up the bargains.
Right. But you've been, Bert, when you say credit market, are you also talking about the bond market or just something else?
Well, the bond market, junk bonds are definitely a part of it. You've got now about $3 trillion, trillion with a T, dollars of junk bonds out there that are just above, or not junk bonds, but triple B bonds, that's just above junk bonds rating. And when risk gets higher, they then become reduced in their rating, and suddenly you've got all of these triple B bonds that institutions have, they get reduced to junk, and many institutions have no choice but to sell them. So this is what happens in a credit crisis, and it doesn't get better.
Right, Bert. So what happens? So here I am. I'm giving people the opportunity to buy my junk bond, but nobody steps up. Nobody wants my junk bond. What does that mean to the market, to you and me, the market? What's going to happen next?
Yeah, Robert, there are different reasons for raising money, of course. One reason might be that other bond offerings, junk bonds that you have outstanding are coming due and you have to refinance them. You have to pay them off. Another reason might be you need them more for operations. And a lot of these are in the energy industry. And the last number I have is about $250 billion with a B dollars worth of junk bonds are in energy. And these frackers, what people don't realize, yes, fracking has really boosted U.S. oil production, but these wells have a short life. It's about 3 to 5 years. Then there's no more oil to be squeezed out of these rocks, Right. And that is the problem. So suddenly there's no more oil, and they have all these bonds, all that borrowed money outstanding, and how are they going to pay it?
Right.
The oil wells are going dry. If you want to read about it.
Bert, hold on. this is near and dear to my heart because oil prices are really low. That also means the oil companies can't pay their debt because they borrowed money to drill the well. So the oil prices are under $50. They cannot service their debt. So they're trying to go out and borrow more money, but nobody wants to lend them any more money. Is that what's going on in simple terms?
Exactly. And about a year ago, the break-even point was said to be about $50 oil. Well, we're below 50. If you're below 50, then suddenly you're losing money. And there are a lot of, this is an average number, the 50. There are a lot of these fracking companies that need $60 oil to break even, So this is the problem. So, you're seeing everywhere, real estate, for example, real estate buildings that were profitable at, when interest rates were 2.5%, 3%, suddenly they're not because interest rates have moved up. So this is the incredible shrinking process now that we have always before a recession. When you listen to analysts, they always talk about, we're not in a recession, therefore the stock market is great. No, by the time a recession is officially declared, the stock market is down 50% or more. So you're too late. You can't wait for a recession to be declared before you take action.
What you talked about, which I always complain about, is CNBC. They call it Bubble Vision and Money Magazine, all these magazines. They have they're not here to educate, are they? They're here to sell their product, most of them.
Well, yeah, they are there to sell advertising space, and they're geared towards the, let's say, the inexperienced investor, And so, I wrote that in July of last year. I said, this is the time you want to put your TV on mute. You don't want to listen to financial TV. Put it on mute if you want to watch a ticker tape, and maybe once in a while they have an interesting, smart guest like Jeff Gundlach and so on. But most of the time, it's very good to use that mute button. In fact, I think that's why they put the mute button on your remote control.
The question now is, what happens now? Like I said to my two friends at Christmas dinner this year, I said, why don't you subscribe to the Wellington Letter? And their minds just froze up. They said, no. How do you feel when people close their mind to what you're saying? I mean, But now, I want you to talk about what you think might happen. Not that it's going to happen, but you think is going to happen, because that's really why we have these programs. Why you write the Wellington Letter.
Yeah, your emotions are always your worst enemy, and the one thing that experience, I've been trading the market since I was in college, and it's 50 years ago, and so you learn something in that amount of time. And you learn to not listen to your emotions, or in fact do the opposite of what your emotions tell you. So if you say, I'm going to go buy Apple, check your emotions first. Apple is in a long-term bear market. Yes, you're going to have a bounce down. It is one of the stocks they use to promote the indexes because everybody has a stock. So these are pushed up artificially by the algo trading operations. They use super fast computers. They can place 90,000 trades, not shares, but 90,000 trades in 1 second. Just imagine that. And that's how they push stocks up. In that rally in February last year, we had this big plunge in the stock market. I said, that's it. The door just shut. But then we had a rally in the stock market for about 9 months. And everybody was so excited about it when the S&P in September made a new record high. The Dow Jones made a new record high. And we pointed out that only 10 out of the 500 stocks in the S&P contributed all of the gains of the S&P 500 during that time period. All of the gains.
I want you wait. Hey, Bert, I want everybody to listen because I can interpret what you just said. I'm sitting here, the market's going, the S&P is going crazy, and you're the only guy I know saying, hey, this is manipulated. There's only 10 stocks out of 500 that are going up. But you also did something else in your Wellington letter, is you said, don't watch the S&P right now, watch the NYSE. Because it's more.
There you go.
And
very good.
But Bert, the most important. I'm trying to sell letters for you, man, because I want people to get educated. So I'm looking at this chart you published. Here's the S&P. It's going to the moon, and then NYSE is going down. And you say this is why it's all coming down. Now, if I hadn't seen the chart in the Wellington letter, I wouldn't know what you were talking about. And so when I'm at Christmas dinner, these guys are complaining and whimpering like a bunch of spoiled brats, which they are. I mean, Bert warned you, right, Bert?
But, the important thing is when you see that your opinion of the market is like everybody else's, it's going to be wrong. That's the best indicator you can find. When you see everybody agreeing with what you're thinking, it's wrong. Last summer, I had even good friends who know my track record and said, oh, no, Bert, you're going to be totally wrong. I was bearish on the market. I said, and at the top, the best indicator you can have is Apple. When Apple finally breaks down, that's it. That's it for the bull market. Because Apple is going to be kept up to the last in order to give the impression that the stock market is in good shape. And that's what Apple is used for. Apple as a company, you don't want to go near it as a company because an iPhone or a smartphone is a commodity item now. Everybody's making them. In China, they're making these smartphones and selling them for $100. Very similar features and some better than Apple, than the iPhone. How can they compete with a $1,300 phone? They can't. That's why they're not selling. In India was going to be the big market for the iPhone. They're not selling any. In India, it takes about 2 years of your income to buy it. You can't go into these markets with such an expensive item. They're finding it out now.
But also, but Bert, the chip makers are taking it right now too. That's why Samsung and those Korean companies, they're taking a hit today because they make the chips for those smartphones or something like that. Yeah,
exactly. So that's a good indicator. If you watch the suppliers for the iPhone, you get a good indication what's happening to the market. So all the suppliers were reporting reduced sales last year, and that was a tip-off. Apple was going to have a big problem.
Right.
They're not selling.
So on September 16th, 2018, the headline of the Wellington Letter is "A Fake Bull Market." Now, my friends at Christmas dinner would never have read your thing. If they had read it, they wouldn't be crying in their beer tonight. So anyway, we'll come back with Bert Dohmen. We'll be talking about what he sees next. Everybody's talking about the Fed and all this stuff. Everybody knows the Fed is run by the rich. It's here only for the rich, not there for you and me. So when we come back, we'll be talking more to Bert Dohmen and his publication, The Wellington Letter, what he sees coming up next. So don't say you weren't warned.
You're listening to the Rich Dad Radio Show with Robert Kiyosaki.
Don't be like Charlie. Charlie is that do-it-yourselfer who does himself in. Do-it-yourself is good for tile and grout. It is not good for asset protection. Charlie thought he'd save a few dollars forming his LLC online. With no guidance, he did it wrong. When he sold the property, he lost thousands and thousands of dollars. He did himself in by trying to do it himself. Don't burn yourself. Use Corporate Direct to set up and maintain your LLCs and corporations. Corporate Direct is owned and operated by attorney and rich dad advisor Garrett Sutton. Garrett wrote the bestsellers Loopholes of Real Estate and Start Your Own Corporation. He is Robert Kiyosaki's attorney for asset protection. He and his team will do it right. Visit them at corporatedirect.com or call 800-600-1760. Mention Rich Dad and receive $100 off your formation fee. That's corporatedirect.com. corporatedirect.com.
Financial freedom begins with financial education. Now back to Robert Kiyosaki and the Rich Dad Radio Show.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. You can listen to the Rich Dad Radio program anytime, anywhere on iTunes or Android. But most importantly, one of the best ways to learn, again, we make no recommendations. We don't say buy this or sell that. We're an education company. But one of the best ways to learn is via repetition. Like you don't learn to play golf by swinging a golf club once. So we archive all of our programs at richdadradio.com. So you can listen to this podcast again. Go to richdadradio.com and you listen to this program and you'll learn twice as much as listen to this the first time. But most importantly, as we always say, get your friends, family members, and business associates to listen to this program again and discuss it. When you discuss it, you'll learn so much more. Your knowledge base will accelerate and you won't be blinded by the fake news about the markets coming out from the press today. So our guest today is Mr. Bert Dohmen. He is the publisher of the Wellington Letter. He has a number of publications. And the Wellington Letter I love for people like me who are just lay people, because Bert takes the time. There's a lot of work goes into his letters to explain why certain things are happening. He has historical viewpoints, but it's really a very, very educational piece. It's timely, it's up to date, it's about today, but he goes back in time and history to explain why what is happening today actually started happening a long time ago. So, Bert, one of the big problems I have with people is that they listen to, let's say, CNBC or they read Money Magazine, and most of them trying to sell their stock. They can't really say anything that bad because they don't want you to say anything bad, where you just tell people what you know. But let me ask you this. How are people deceived listening to people like, let's say, CNBC?
Well, I think financial TV reflects the popular opinion. That's what it is. And if you want to make money in the markets, you want to stay away from popular opinion. I think this, 2018 was so educational to see everything that I've been talking about for decades. And, in late September, in fact, it was the September 30th issue of the Wellington Letter, the headline, the Dow Jones had just made a new record high 2 days before. And the headline was The Last Gasp. This was the last gasp of the bull. And we said it's down fast and furious in October. Now, the Investment Advisor Sentiment Survey, which is done every week, had 61.8% of the investment advisors being bullish. That was one of the highest levels in decades. Okay, so everybody was bullish, and we said that is the best signal that we're at a top. When everybody is bullish, that means everybody is in the market with all of their money, and there's no support on the way down. Nobody has any money to buy on the way down. I attended a meeting because it was very close by. It was in California of the AAII, and they had a number of professionals on stage and so on. But they asked for a show of hands. That was middle of October. The market had just had 2 weeks of straight down plunge. $6 trillion of value of stocks had gone up into smoke. And they asked for a show of hands of the audience. And these are serious investors who are members of the AAII. And they asked for who was buying. A lot of people were buying during the plunge. The last question was, who was selling short? And I was the only one to raise their hand. So that was a confirmation. To me, I was on the right side. I always love to be in a minority. Whenever I see that my view is the majority view, I know I have to change my opinion. And so that shows you your popular opinion is what you see on TV. It's a consumer channel, and most of these people, I always tell people, when you hear an opinion, ask what does that person do? Do they manage money, or do they work for a Wall Street firm? Either one is highly conflicted. We have no conflicts. I don't manage money. I don't take advertising, etc. I can say sell and I can say sell short, and nobody's going to get angry. And that's the most thing. When you see a money manager going on TV, how do you think if somebody manages $5 billion, can he ever say the market is going to go down? He cannot, because his clients are going to say, then why are we holding stocks? You know? So
right.
He can never say we're in a bear market. We are now in a global bear market. And you're going to have a rally, and you can see the opinions now. Oh, wow, buying opportunity. Look how much cheaper stocks are. Apple is down 38%. What a bargain, you know. But they forget the message. You have to look at the message of the market. When stocks, very popular stocks like Apple and Facebook is down, 45% or something like that. I mean, hundreds of billions of dollars and just a few handful of stocks have been wiped out. And everybody thinks it's a buying opportunity. No, the market is telling you there's something very serious ahead.
So let me ask you this, a little minutia question here. How in the world can the market drop, let's say, 500 points, and then the next day it's up 900 points? What the heck's going on? Or
actually in the same day as well.
Yeah, why?
How does
it do that?
Well, my prediction has been that we're going to see a day where during the day, not at the end, but during the day, the Dow Industrials will be down 2,000 points. And that is when all the algo traders, all these automatic trading programs hit the sell button at the same time. And that's what we're seeing. That's why we have these huge and these fast moves. These are computers making the decisions to buy or to sell. And that's what causes this. There's no human intervention until it's too late.
So they're all following certain words pop up on the algorithm, and that means sell. So they all sell simultaneously.
Yeah, and that's one of the methods that they have. The computer scanned, say, Dow Jones Newswire for items, and there are certain key points. And when they come through on a stock and so on, like a surprise on the downside in earnings, boom, they hit the sell button. Doesn't take a human being to hit that button. It's the computer that hits it.
But how does it go back up? Are they buying Are they hitting the sell buy button also?
That's when the human intervention comes in. They say, okay, this was triggered. We don't think that trigger really worked very well this time. We have to reverse it.
So on the sell side, it's the algorithm, the machine firing off, and when the buy comes in, it's a human stepping back in.
Yeah, usually, yeah.
Wow.
Usually they're reversed. I'm not privy to all the algos. Nobody is. They keep these algos that everybody uses, very top secret. And so everybody uses different algos, but I would bet, in the analysis, everybody uses similar algos. Therefore, you're going to get to the point where it's just like, in 1987, we had that crash. The Dow Jones was down 23% in one day. And that was when the so-called portfolio insurance hit. Everybody hit the same sell button. And that was it. The market was down 23% in one day.
So let me review what you've been saying. So the stock market is fundamentally a reflection today of the credit market, and there's no money in the market to buy the junk that people need to roll over and do all that stuff. So the money's drying up, and that means the market is hanging up there all by itself. Is that what you're saying?
Yeah, basically, I developed my theory of liquidity and credit is what I call it. In 1976, I started my business in 1977, and it was at the beginning of a bear market. It was the lowest number of people that were bearish on the stock market ever. It was 3.8%, according to Investor Intelligence. And I said, why doesn't anybody see this bear market coming? So in January of 1977, I put out the first issue of the Wellington Letter. I said, I want to have it in writing that I did predict the bear market. And lo and behold, the bear market started. The Wall Street Journal picked up the Wellington Letter, and I was one of the very, very few bears around. And so that made the business for me. And it was based on shrinking liquidity. That's what you want to look at. When it becomes harder for businesses that are in good shape to get money, when it gets harder for companies that want to sell junk bonds to sell junk, like right now we have 80% of the bonds that have been issued here in the last 10 years are these covenant light bonds. In other words, there's almost nothing behind it except the promise to pay you back, whereas bonds used to have covenants attached to them. You have to meet certain financial ratios in order to keep your credit.
Right.
All that stuff has gone by the wayside.
Right.
So we're right back to where we were in 2007.
Okay, and there's one more question I have is, in my opinion, but I think we're in a 70-year secular bull market, which means the market's been going up for 70 years. And is it possible we're at the start of a long-term bear market? And the trouble with a 70-year secular bull market is that's all baby boomers know. Baby boomers do not know the Depression. So is it possible in your view of the big picture, the macro of the market, could we be heading into a secular bear market, which is a long-term downtrend? Is that possible?
Yes, I think it's great that you point that out. That is my view. We are at the end of a secular bull market, and this is going to be down for much longer than normal. You hear guys on TV talking about, the average bear market is only 18 months. This is going to be probably twice as long, and it's going to be probably twice as severe. And so, we have to remember that where we came from. These, we had basically a zero interest rate policy. Remember that? It was called the ZIRP, zero interest rate policy. At zero interest rates, you can borrow a lot of money, and it doesn't cost you very much. And that's what we had. So everybody borrowed and borrowed. I'm not talking about individuals. I'm talking about companies.
All over the world, too.
Interest rate, all over the world.
Even
Europe, they still have.
Argentina's still borrowing money. So Argentina's going by the way of Venezuela.
Yeah, exactly. And, everybody borrowed all over the place at very low interest rates. Now they have to pay much more for their money. And it's huge in percentage terms. If before you had a loan and you paid, like the stock buybacks that Apple has been doing, they've done the biggest stock buybacks of any company. They borrow money to do those. They borrow money. They were able to borrow money at about 1.5%, I believe.
And
and now they have to pay, let's say, 3%. That's a doubling in the interest cost.
Right. So
that's a huge increase.
So what Bert is saying with this thing called the secular bull or bear, secular means long term. So the market can go up and down. You can have booms, busts, and all this. But since the end of World War II, baby boomers, all we've known is up. The question I want to ask you, Bert, if you are a baby boomer right now and you're sitting with everything you have, is, I don't call it a diversified portfolio because most people aren't diversified. They're diversified. I mean, they're all in stocks, bonds, mutual funds, sometimes in the same stuff. If you were a baby boomer or a child of a baby boomer and you're sitting there and we're about to head into a secular bear market, you have any ideas?
Well, I can only say in the last 3 months when everybody was losing their shirt, I made huge profits. So did our subscribers to the trading services. Have you ever noticed that stocks go down faster than they go up?
Yep. As I say, the
bull. That's why bear market is. Every bear market so far in 41 years of my business has been very profitable to our subscribers. Correct. Because we've told them how to make money in a down market.
Right.
And that, in fact, that is our slogan. We're making money in bull and bear markets. Bear markets are wonderful if you know how to make money in.
Correct.
Because you're not in the masses. You never want to be in a herd of cattle. Where nobody uses any brains for analysis. They say, well, so and so says I should buy Apple or XYZ, and therefore I will do it. No, you got to do your own work.
So
investing is hard work.
Yep. And I make no money on this. I have no dog in this fight. But I really want people to wake up and smell the coffee, because I think we're about to hit a secular bear market. So everything that worked in the bull market for the last 70 years will be opposite for the next, 5, 10 years. So all that free opinions you get on CNBC is free, and the reason it's free is because it's not worth anything.
When I speak at conferences, I basically stopped speaking at conferences because it's just not worthwhile. You hear all this stupidity. The last time this was a few years ago. Oh, to make money in the market, just take one good stock and sit on it forever, like Microsoft. And I just happen to know Microsoft. The time that Ballmer was there, I think it was a period of 16 years, the stock was still down. 16 years, starting in year 2000.
How about General Electric? How about General Electric? Those poor...
You cannot do. You have to be an active investor,
right,
or an active trader.
Please listen.
Cannot just. The world changes. It's a dynamic world,
right?
And people have to realize that all this stupidity is taught people by Wall Street. Wall Street has to have people to hold the stock on the way down.
Right.
Wall Street owns the stocks on the way up. Then they have to sell them at the top, which was last year was beautifully executed. A 10-month rally, basically based on 12 stocks. 12 stocks rallied, and everybody thought the entire stock market was going up. And we kept showing the chart of the New York Stock Exchange Composite, which is every stock on the NYSE, and it wasn't going up. And we said, this is a trap. A huge bull trap is being set. And then they send out all of their shills on TV. Oh, the stock market is great shape, and the economy is wonderful, and earnings are wonderful, and so on. Have you ever considered earnings show you the past? Do you drive your car only looking in the rear view mirror? I think you look ahead once in a while, right?
Right.
So it's the same thing in the investment market. You want to look ahead.
So, Bert, we gotta take a break. But I want to ask, we have our most popular part of our program is called Ask Robert. Would you be willing to stay on for another 10 minutes and answer the Ask Robert questions? Because I'd rather have you answer them than I answer them.
Well, I'll try my best. Sure, I'll stay on, yeah.
Okay, so we'll be right back with Bert Dohmen and Ask Robert.
You're listening to the Rich Dad Radio Show with Robert Kiyosaki.
What is your number one expense in life? Your number one expense, it's taxes. And I've asked the question is, how come there's no financial education in school, but why isn't there education on taxes either? They tell you to save money, which is stupid. They tell you to invest in the stock market, which is stupid. But won't they teach you about taxes? So here we have Rich Dad advisor Tom Wheelwright. We're talking about his revision for his book, Tax-Free Wealth. Welcome, Tom.
Thanks, Robert.
So what's the tax-free wealth about? What's different this time? It's a revised edition.
Well, so what we did was this is the first major tax reform we've had in 30 years, 2017.
Was 86 was the last one?
86 was the last one, back when I was in Washington, D.C.
So many guys got wiped out because of that tax change.
They did. It wiped out an entire industry, savings and loans. This new tax law is just as big, but in a very different way. It affects different industries. The tax law is always a series of incentives. And the question is always which incentives and which ones apply to me. And so the key to revising tax-free wealth was, what changed so much in this new tax law that we can absolutely take advantage of? Seriously, the amazing incentives. For example, the bonus depreciation, for example, for real estate is unbelievable. You buy a $1 million apartment, get a $300,000 deduction or more the very first year.
So if you want to make more money and pay less taxes like Donald Trump and myself, get Tom's book, Tax-Free Wealth.
Don't be like Charlie. Charlie is that do-it-yourselfer who does himself in. Do-it-yourself is good for tile and grout. It is not good for asset protection. Charlie thought he'd save a few dollars forming his LLC online. With no guidance, he did it wrong. When he sold the property, he lost thousands and thousands of dollars. He did himself in by trying to do it himself. Don't burn yourself. Use Corporate Direct to set up and maintain your LLCs and corporations. Corporate Direct is owned and operated by attorney and Rich Dad advisor Garrett Sutton. Garrett wrote the bestsellers Loopholes of Real Estate and Start Your Own Corporation. He is Robert Kiyosaki's attorney for asset protection. He and his team will do it right. Visit them at corporatedirect.com or call 800-600-1760. Mention Rich Dad and receive $100 off your formation fee. That's corporatedirect.com. corporatedirect.com.
It pays to listen. Now back to Robert Kiyosaki and the Rich Dad Radio Show.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. Once again, you can listen to the Rich Dad Radio program anytime, anywhere on iTunes or Android. And all of our programs are archived at richdadradio.com. Again, we archive them because we're a purely educational company. We don't recommend you buy and sell any kind of asset or stock or bond. We're purely selling education here, and most of it's for free. If you want to learn more, go back to richdadradio.com. Listen to this podcast again with Bert Dohmen, publisher of the Wellington Letter. Listen to this again, discuss it with friends, family, and business associate, and you'll learn twice as much as you have now. So we're coming to the most popular part of our program, which is Ask Robert, and you can submit your questions to Ask Robert at richdadradio.com. And I'm very happy to say that my friend Bert Dohmen has agreed to stay on to answer the questions because he's a lot smarter than me when it comes to many of these questions. So, Melissa, what's the first question for Ask Robert?
Our first question comes from Miguel in Fort Lauderdale, Florida. Favorite book, Rich Dad's Guide to Investing. If you're fully invested and there's a long-term bear market, what do people do?
So, Bert, I think that's really the big challenge is because most people, like I said, if it's a 70-year bull market, the average guy doesn't know what it's like to be in a bear market. And I had a business partner who was in his 90s, but he always said, he says, you have no idea what it feels like when the market just keeps going down. And he was a child of the Depression. So what would you say to somebody, what would you do if you're 401k, an IRA, or a retirement plan, and the market starts going down, and you know that the idea of the market's going up or making money from capital gains is gone? What would you recommend to people?
Well, you want to have the asset that very few people have, and you want to have cash. Nobody has cash. Everybody has a lot of debt. Cash is going to be king. And if you have cash at the eventual bottom, which may be several years from now, you will be able to buy tremendous bargains. But this is not the time to do it. You're going to have a rally in the stock market. In fact, this rally that we're in, this may be the last opportunity you will have to really sell at better prices. And you sure don't want to go down the tube in a bear market being fully invested. You know, our clients, our subscribers got out in late September. That was our advice. And so the ones that were more willing to go short or buy ETFs that are inverse ETFs, this is a wonderful instrument now for people who do not understand short selling. You can buy an ETF that is designed to rise in price as the stock market goes down. So that would be another great way to do it. I would not use leveraged ETFs. They have them also that are leveraged. I would not do that because then you're getting into the speculative realm. So I would have part of the portfolio in such inverse ETFs and part in cash. We have a program here, and this really reflects my thinking. We have 5 model portfolios, and the program is called Hedge Folios because 3 of the portfolios go into these inverse ETFs. And you can replicate our portfolio just with a click of the mouse. And when we make a change, like yesterday, people get a notification by email and by text message. They log in. They see the changes we made. If they agree with them, they just click the mouse, and right away their own portfolio is lined up with our model portfolio. So you know exactly what we would be doing. And if you like what we're doing, then you just line up your portfolio with ours. It's all done automatically. It's wonderful. And 3 of the portfolios are allowed to have inverse ETFs. 2 of them, we call it conservative portfolios. They have only cash or or other ETFs. And right now they're in about 90% cash and have been 90% cash for 3 months. And as you know, cash way outperformed stocks in the last 3 months.
So once again, as Robert Kiyosaki, we make no recommendations, but I will just say this much. The recommendation is please get educated on these matters. And Bert is one of the best I have come across. I love his Wellington Letter because it's really an educational piece. It's not buy this, sell that. So, and I don't vouch for him or not vouch for him. I make no money off of this whole thing. But I am concerned because I think we're going into a long, long, slow decline right now. And if you're hoping the markets will go up, well, then I'll pray for you. But it is much better for you to make money with the markets go up and the markets go down. To me, that makes more sense. So I want to thank my friend Bert Dohmen. Please subscribe to Wellington Letter. Again, I make no money off this whole thing. I just want people to get educated. He's one of the best educators in the world today. And I agree with him. I've gone to a lot of these conferences. Everybody's got a point of view, but I think Bert does the best at educating people. So once again, thank you for your questions. So Ask Robert. You can submit your questions to AskRobert@richdadradio.com. So Bert, thank you very much. I look forward to having you back on again because things are changing so fast right now.
Well, thank you for the opportunity. I really enjoyed it. And, the greatest pleasure for me is if I can help a few people avoid big losses or make some money in the markets. That's the best. I've been doing this for a long, long time, and it's cost a lot of money. The learner's permit in this business is very expensive, and I paid it with my own money, not with other people's money.
Yep, and your insights are just absolutely spot on. So again, thank you, Bert, and thank you all for listening to richdadradio.com.